Treasurer's Investment Advisory Council, where we help provide information for the people that manage the state funds, the cash funds, long-term real estate funds, and several other things that they do like that. So, New Mexico teachers, that sort of kind of institution, where I'm providing with interest rate strategies, duration strategies, yield curve strategies, sector analysis, that sort of thing. So, I've been doing this for a long time. Started in the money management business, got out of it, got into the consulting business, and now I've gotten back in. So, I'm not technically an economist. I call myself an economic strategist. The guys with doctors of economics get really upset if you tell them you're an economist, because I have undergraduate and graduate work in there, but I don't have any doctorate behind my name. But I learned my approach to interest rates in the pits. I was a trader for several years in the fixed income markets, traded government securities, mortgage-backed securities, and corporate bonds. So the way I view the world is from the interest rate perspective. I think interest rates make the world tick. When interest rates are at specific levels, they really define what's going on in the universe of activity. What used to be a domestic issue in the 70s, 80s, and early 90s, it's now a worldwide situation that you have to look at. And the worldwide situation is dictating what happens with interest rates just as much as the domestic are. This is the constant maturity rate for the 10-year over the last almost 60 years now. Now, obviously, we were growing by 15% back in the 80s, but there were some unique things going on at that time, which I'll run through, that I think defined what created that environment, and they are not going to be duplicated in the future, what I would call the realistic time frame future. These are really a couple of things that I'm going to talk about. The top one and the bottom one are basically important in terms of looking at the interest rates for the next couple of years. The middle two are basically what we have to look at when we talk about where long-term interest rates are going to be in the long term. Now, nobody knows where they're going to be in 10 years. I've been doing this for 40, I can tell you there's no way. I thought in 1980 they were going to go lower, they did. But I didn't think they were going to go as low as they're going, I have to tell you that. So, if I would have known that, I'd have bought all of the DC-10s that were issued in 1980 that paid 10% interest for the last 30 years. I owned them, but I sold them at like plus 25% like everybody else. The next 2 years, next 2 to 3 years, rates are going to stay much lower than people expect them to for a variety of reasons. One of them is the Federal Reserve, both our Federal Reserve and the other central banks of the world, have basically gone into a mode of they know that they have to provide liquidity because there's these potential austerity measures, fiscal responsibility measures that are going to start coming into play in various countries throughout the world. The Fed is very sensitive to that, as are all other central banks. And you have to remember a very important thing, because you hear stories of some emerging countries that are growing very nicely and growing very well. But if you look at the United States, you look at the Eurozone, and you look at Japan, they roughly represent 75% of the GDP in the world. You add on China, you add another 18. 88% of the activity in the world is defined by those four groupings. The central bank activity is really going to dominate where interest rates are for the next 2 or 3 years. That's the essence of that discussion. We have too much stuff and too many things. We have 15 million partially unemployed or unemployed people in the United States. Commercial real estate, we all know you guys know this as much as I do, that there's plenty of availability in that area. There's still a lot of retail vacancies. There's still a tremendous number of depending on who you believe, $5 to $7 million worth of 7 million unsold homes in the United States. Doesn't sound like all that much, but we're only running at about a 400,000 per year rate in terms of increasing new home sales. 6 million, 400,000 a year, going to take a long time to get rid of that excess supply. So we basically have too many things. What that ultimately winds down to is you don't have any pricing power. And if you don't have pricing power, it's very difficult for things like inflation to get themselves started. And if you don't have inflation, that's one of the components that's going to affect long-term interest rates. So the too much stuff and too many things is really going to have a lot of impact for the next 2 years. Unemployment situation is a very good example. With those 15 million, even if we add 200,000 jobs per month to our monthly payroll numbers, which by the way we aren't averaging yet, it'll still take over 5 years to put all of these people to work that are unemployed. So there is no labor price pressure. Unit labor costs have been stagnant for the last decade. And that's partially why we're beginning to see manufacturing jobs move back into the United States. The other part that's going to affect us in the short run is banks are going back to being banks. You know as well as I do how much hard dollars I have to go into deal and how hard it is to get leverage on anything. That is not going to change. I guarantee you, with all of the financial regulations that are out there, banks are going to continue to be very reluctant to lend money to anybody that isn't gold-plated, and that's not going to change because the capital is going to continue to be pigeonholed instead of lent. The European banking situation is much worse than our banking situation was, much worse, because they are so reluctant as a group to address the problems. So anytime there's concerns, okay, like right now, we don't know if Greece is going to default or will default, won't default, but when Greece is done, Ireland is going to come into play. Spain potentially could come into play. Italy's going to come into play. Italy's about to enter its first. The European situation is going to cause these flight to quality rallies which affect long-term interest. As we in the investment business know, you can't get any rate of return. The 5-year Treasury is trading at 82 basis points. I mean, these rates of return are absolutely ridiculously low. So what people are doing is whenever there's a flight to quality rally, whenever there's concern in Europe, there's a tremendous flight to quality rally over here, continues to push our interest rates down. And the Fed is already out stating that they don't feel that they're going to raise interest rates for 2 years. And when they start raising interest rates, because of the unemployment problem, they will not raise interest rates by 1% and 2%. They're going to go at this very reluctantly. A quarter here, a quarter there. So that's the outlook for 2 or 3 years. That one's easy. 10-year interest rates are artificially low, even given all of these things that I just talked to you about. Where do I think rates will be in 5 to 10 years? And that's where the headline of my chart goes. They're going to be lower than you think they're going to be. It's a deleveraging cycle for us. It's been a deleveraging cycle for Japan for over a decade. And it's going to be a deleveraging cycle for the European community. Ease like we had in 2006 and 7. Roughly 8 to 10 years. We're 4 or 5 years into that. So just that rough rule of thumb, we got 5 more years of just deleveraging, okay? Deleveraging means that you take the incremental demand out of the system. What we've seen is we've seen deleveraging in the corporate community for basically the full 5-year period of time. So cash flows are pretty strong in the corporate community. They have a tremendous cash buildup. They don't know what's going to happen politically or taxes-wise, and therefore they continue to hoard cash in very big amounts, as we've talked about. That hoarding of cash just forces them to invest in the short-term part of the curve, keeps interest rates low. It's all a giant circle. A circle of fear is what I call it. Circle of uncertainty. It's deleveraging. That has been forced deleveraging by foreclosures, bankruptcies. That's not been voluntary deleveraging. But in an environment of slow growth, our nominal growth is running basically between 2 and 3%. The average consumer, the average individual out there can't tell the difference between 2%, zero growth, minus 1% growth. You just can't tell. I mean, it's an economist cartoon. It really is, because until you get nominal growth up towards 5% and higher, you're not going to get the consumer to get back into the game, essentially, to get back into the game of participating. And the game in the United States is consumption. Consumer is 70% of our economy. So until we get the consumer back in the game big time, you're not going to build up the demand side of the system. In the 80s that created those extremely high interest rates was a confluence of events that I don't think will ever be repeated. Frankly, they won't be repeated in the United States. I think they will be repeated in China, but they won't be repeated in the United States. During this period of time, we were obviously coming out of this, we had the Vietnam War going on. We had unit labor costs were growing at about 4 or 5% during this period of time. And we got into the mid-70s, and all of a sudden, unit labor costs began growing at 10 to 12% per year. They grew above 10% levels for almost a decade. GDP was running at between 8 and 12% a year during that period of time. It was heaven to be in business in that part. And on top of that, you were going from one family employment to two family employment, big demographic change. And you were moving from, I remember going through this, you were moving from an apartment, you had the baby boomers moving from an apartment to a house, with a one-car garage to a house with a two-car garage. You bought one car, then you bought the second car, you bought the first TV, now you buy 7 TVs. It was a consumption binge like we have never seen in our lifetime. We lived through it, we did it, but it will not be repeated, and it was a tremendous amount of demand pressure on it by what was going on in our economy. And prices exploded, and the administrations didn't know what to do. When the prices exploded, then we did get inflation, and interest rates had to respond. Every time push came to shove in a financial crisis, the dollar strengthened, and we're getting dollar strength right now. We had dollar strength during the financial crisis in 2008. And that's because a certain marginal flow of capital is always going to come here, because we have the safest financial system in the system for people to put their money to work. So if you're 85% of all transactions in the world are still done in dollars. No, they're not going to get aggressive. They're not going to get aggressive until they understand all of the financial regulations that are put in place. I was just at a presentation by the head of mortgage lending for the Bank of America. And he said, as direct as he could to the political powers that be that were in place, we are not going to make mortgage loans because we're afraid that if we don't sign the documents correctly, we are going to be liable for those issues. There will be no more bailouts. And that's in the mindset of all of these people. It doesn't matter if you're running a $100 million bank or a $100 billion bank. They know they've got to have the capital. Will they grow loans? Yes. Will they become aggressive? The cross-border risk for our domestic banking system is still almost $1 trillion. Down the most of any sector out there. Retail housing's getting awfully close. And down 35 to 40% has always been where it always paid to get involved in these things from market peaks. But because there's been so little resolution of the banking problem in Europe, and it's so much bigger than ours, it's difficult for me to go blindly in and say, leverage them. Now, I think I have no doubts about things being cheap. The question is, how long will they stay cheap? That's my only issue.
How far out would you hold that fixed?
Safely 5. So that's why I say safely on a 5, because you don't have much interest rate exposure on the 5-year because it's so tied to what the Fed funds is going to be over time. The situation is 18 months to 24 months behind us. Okay? So whenever our rates start going up, their rates are going to go up 2 years later. Because of the banking system. Yes. Real growth is only running at, real growth in the last quarter would have been almost 5%, except we had almost 2% decline come out of the government sector. What we're going to go through now is, government is basically 20% of GDP. If the Republicans get in place, they're going to start adopting, we're going to have more pro-growth, you got to get employment up, but they're also going to have to raise taxes in certain areas. They're going to have to give somewhere because there's no money to solve the problem unless they give somewhere. So the only thing that I can assuredly tell you about 2013 is taxes are